Well, seemingly out of nowhere, we had three pretty significant developments today, all of which add a pretty negative tone to the market and our overall economic outlook. This includes today's jobs data, what looks like a shift in sentiment by the Fed and Fed funds futures for that matter, and most importantly, the bond market just did something today that it hasn't done in years. Starting out, we're talking about the disappointing JOLTS data. America has the fewest jobs available since January of 21. Of course, we're referring to the job openings and labor turnover survey that was released earlier today, and it shows us a massive decline in the sheer number of job openings. Now, these are reported in thousands, so we're currently looking at a level of 7.6 million. That is the lowest low we've seen in quite a while. Certainly a massive decline from the 11.5 million number of job openings we saw in July of 22. Certainly not good news to say the least. Here we see the JOLTS also reports the amount of quits. And what we'll see here at a level right now, 21,000, is that it's not as significant of a decline. It shows us that, those of us that have a job are not quitting, and we're not quitting because we know the job openings survey out there, the job situation is quite bleak. So not so many people are quitting, but there's less and less job openings. We're going to explain exactly how that's happening. Also, we look at the hires too, these amount of new jobs that are being hired. We're at a level of 5.5 million. And again, this is the second lowest low we've seen in a very long time. Certainly a very significant decline from the levels going back to July of 22 as well. Now, in blue, that's the job openings. That's declining. In red, the layoffs and discharges. That counts for all types of different situations where somebody may not work or may leave a job. Now, we can see that while the layoffs and discharges aren't really changing that much, relatively speaking, the job openings are declining. Now, wait a second. If someone leaves a job, if somebody quits a job, it's logical that that company will hire somebody new. Not necessarily. Maybe as a result of AI, maybe as a result of the economy or the business's outlook. Nevertheless, there's less people working today in these companies than before. They're not replacing people who are leaving. Now we also see this is openings divided by hires, meaning how many openings per hire. And what we saw going back to the beginning of 23, we had 1.8 job openings. When we open up a website and we say, okay, let's look for a job, there were 1.8 openings for every job that was actually hired. That number now is 1.4. There's far fewer openings out there. Now, in blue, we see the job openings reported in thousands. And just to show you how significant this downturn is, we're now looking at levels, actually the lowest lows we haven't seen since January 21. February 21 was just a little bit above that. And this is a very significant pullback that we see. There's fewer job openings now than since just after the pandemic during those very turbulent markets. Now, speaking of the Fed, Atlanta's Fed Bostic, the central bank can't wait for inflation to get to 2% to cut rates. Why would he say this? Well, he said, in particular, he believes the central bank cannot wait until inflation hits 2% to cutting rates. Why? We must not maintain a restrictive policy stance for too long. He says, I believe we cannot wait until inflation has actually fallen all the way back to 2% to begin removing restriction, meaning cutting interest rates, because that would risk labor market disruptions that could inflict unnecessary pain and suffering. I'll ask you, let us know in the comments, do you think we're already suffering labor market disruptions that could inflict unnecessary pain and suffering? I would say so. Typically, we understand the Federal Reserve has a 2% inflation target. We're in the mid twos right now. Bostic is saying that we don't want to wait until inflation exactly gets all the way down to 2%, because if we wait that long to cut interest rates, we may inflict a lot of pain on the jobs markets. And by the way, it's important because Bostic is a voting member this year. His vote counts. We have voting and non-voting members in the Federal Reserve. So he is voting certainly in favor, probably of cutting rates sooner rather than later. Now, speaking of the Federal Reserve and their voting, we have here the Fed funds futures in red. The probability in September, the Federal Reserve will cut interest rates 1/4 point to 5.25. That's in red. And then in yellow, a 0.5 point cut, 4.75 to 5. And what we saw just in the past day or so is that the odds that the Federal Reserve would cut rates 1/4 point, only 1/4 point, went from 62 down to 55%. That's a pretty significant drop. Conversely, the probability the Federal Reserve would cut rates by 0.5 point in September, by the way, 0.5 point. Yesterday it was 38%. It's now 45%. So maybe as a result of the JOLTS data, maybe as a result of some of the other developments in the market, and we see a lot of weakness lately too in stocks. Maybe the Federal Reserve is leaning more towards cutting rates more, a 0.5 point. The odds still say we're going to get a 1/4 point cut, but we're leaning more towards a 0.5 point cuts. Now we see here in blue, that's the 1/4 point cut in September. And we have a 55% chance still that the Fed will only cut rates by 1/4 point, 45% chance of a 0.5 point cut. That's in September. But this is interesting. In November, we have going from the current rates to 4.75.5, that would represent a 0.5 point cut. There's a 29% chance that would happen. There's a 50% chance the Federal Reserve will cut rates that interest rates will be down 0.75 points from present rates by November. Just a few days ago, the last time we pulled up this chart, this did not say this. Last time we looked at this, we were looking at a 1/4 point cut in September, a 1/4 in November, and 0.5 point in December. That has now shifted. We're now looking at an overwhelming majority probability we're going to get a 0.5 point cut in November. Is there a conspiracy theory that the Federal Reserve meeting in November is just a couple days after U.S. elections? Well, that's a different story. By the way, in December, there's a 38% chance, that's the highest probability, that will be down a full percentage point from the current 5.25 to a 4.25. But the shift definitely is moving in favor of deeper cuts sooner. Now, by the way, we can see here in blue, that's a 4.75.5 level. In red, 4.50, 4.75. And in white, that's a 4.25, 4.50. This is the November meeting. And in particular, notice what we're looking at. Yesterday, there was a 45% chance that we were going to be down 0.5 point in November, and 45% chance that we'd be down 0.75 point. Well, now today, there's a 50% chance that we'll be down 0.75 point in November, meaning a 1/4 point in September and another 0.5 in September. This is just to demonstrate how much the futures have moved in the past 24 hours. Now, speaking of unprecedented events, the bond market yield returns to normal from an inverted state. Now, that originally had raised recession fears. I don't agree with this title. I don't agree that it had raised recession fears. I think that this reinforces recession fears. I'll show you what we mean. First off, let's take a look at current yields. And what you'll notice is that the 2-year and 10-year have the same rates, 3.76%. What we've seen for quite a long time, several years now, our interest rates on the 2-year, the shorter term yields were higher than the 10-year. I think it actually dipped even a little bit below the 10-year today. This is a pretty significant development. In red, the 2-year maturity. In white, the 10-year maturity. And notice what we're looking at here. The 2-year, the red line, has dipped down to the same rate as the 10-year. It was significantly higher for several months now. Several years actually. Now in gray, S&P 500. In blue, now this is 2008, just to give you some perspective. In blue is a 2-year, in the red is the 10-year, and what we look at is the crossover. And this is why the crossover, the end of the inverted bond market, I think reinforces recession fears. Because typically what happens is that when we have an inverted bond market, when that blue line was above the red line and then crosses back down, that usually coincides with the beginning of major market weakness in stocks. Gray area chart here is the S&P 500. Now, does it always have to lead to a market crash? Not necessarily. If we saw, for example, the inversion end where the 10-year crossed back above the 2-year, if these lines were going higher, that would be encouraging. Higher interest rates mean a more optimistic future, but that's not happening here. And it looks like the 2-year, which the short term maturities, of course, are more reactive to interest rates and the near term future economy. It's now, this was in 2007, was now forecasting that trouble is coming and probably coming soon. Now, fast forward to present day, we can see just how long we've had an inverted status for. Notice the inversion began in the 2 10-year spread that was around 21. In 22, it was a 110, I believe. We're still inverted on the 110, but the 210, we can see it was inverted. The red line was above the white line for several years, and it looks like that may be coming to an end in the near term future. This week, we have a lot of really interesting things going on. Thursday, ADP employment, and of course, Friday, probably one of the most significant economic numbers in this quarter. It's the employment data. Remember, last month's employment data was not good. I think the estimates are the unemployment rate, they're expecting to drop down to 4.2%. But if this number disappoints, this could create a lot of urgency for the Fed, and it could create a lot of urgency for the stock market, and not in a good way. By the way, the other day we spoke about this, and it's really quite interesting. We looked at the M3, which are factory orders, manufacturing orders, a lot of data we read from the manufacturing sector. In particular, we look at capital goods. What are capital goods? Capital goods are those things that businesses and factories will buy if they expect the economy to improve. Machinery, forklifts, new software, new computers. A restaurant may invest in new ovens and equipment for the kitchen, that sort of thing. Well, we see a massive decline lately in capital goods. And what this study that we did shows us is that in the prior recessions in 2001 and 2008, this particular part of the M3 data was actually the weakest and most sensitive to those stock market crashes that ensued afterwards. We took a look at this data, and I think that what you'll find here is going to be quite interesting. We hope this has been helpful. We look forward to seeing you back soon.